Hello and welcome to Forex Academy, your #1 website for Forex and crypto education and analysis. In today's edition, we're going to be discussing Forex options, option pricing. Firstly, we're going to look at supply and demand. The price of a given option is determined in the real market by supply and demand. That means a buyer and seller must agree on a determined price to complete a transaction. A buyer willing to buy at market price must pay the ask price. A seller wanting to sell at market price should accept the bid price. Option spreads are usually larger than spot spreads. For instance, the typical spread of a Euro-USD spread is 3 to 4 pips, but its lower risk at a reduced cost makes them attractive to knowledgeable option traders. A probability game. Options trading is a probability game. The long-term profitability of an option strategy is linked to the traders trying to buy undervalued options and sell overvalued options. Therefore, the traders should have a clear understanding of theoretical versus market valuations, and in the case of FX options, knowing the underlying market fundamentals. The majority of option traders use an option as if it was the underlying, buying calls when they think an asset will go up and buying puts when considering it will go downward. The issue is that the options are wasting assets, thus in most cases that approach is unprofitable. Structured approach. Most authors consider that to trade options successfully, a structured approach is necessary. A trading plan is needed, and in addition, developing the discipline to follow it. The benefits of a structured approach are: emotions are eliminated in decision-making processes. There is no psychological need to be right. The best thinking effort is made before the battle, avoiding subjective decisions. The theoretical pricing model. Options are complex investment products as it involves estimating the odds of the price of an underlying asset to surpass the strike price within a given time lapse. The most used model is the Black-Scholes equation that uses the price, volatility, time, and interest rates to compute an option's fair price. The basic idea of the Black-Scholes model is that the right to delay a decision to buy an asset at a specific price has a value, which can be computed. A general trait of these models is the assumption that the distribution of price in the market is Gaussian or something close to it, on a logarithmic scale. Although the Gaussian distribution is an approximation to the way prices move, it is essential to understanding the price model's statistical nature. Under this model, the price movements of the underlying assets move also following the normal distribution. If you've followed us in our Stats for Traders video series, you understand by now that 68.2% of the values following the bell-shaped curve lie within one standard deviation from the mean, and 95.4% of them lie within 2 SDs. That means that only 31.8% lie away more than one standard deviation, and that 4.6% go farther than 2 standard deviations. In the case of an option, we are interested only in this side of the bell curve. In this context, only 15.9% of the data points lie beyond one standard deviation, and 2.3% beyond 2 standard deviations. The Black-Scholes-Merton formula is as follows. D1 and D2 are calculations of the area point in the curve, which will show the price's odds to reach that point. As said, the Black-Scholes-Merton equation assumes that price movements follow the Gaussian distribution. That, combined with the expiring date and the knowledge of the volatility or sigma of the asset, are key ingredients to assess the fair price of the option. If we were to buy the absolute fair price, the model would predict 0 gains and 0 losses in the losing term, but the volatility in the market is not constant but changing. Therefore, the ability to evaluate which options are cheap or expensive under our forecasted scenario showing a higher or lower future volatility is one of the elements for success. In the next video of the series, we will develop the volatility concept and apply it to options. If you enjoyed the video, then please like and subscribe and leave a comment down below about anything you would like us to discuss in future, or if you have any questions about this particular video. Have a great day.